London's century-old silver market is in turmoil. A powerful short squeeze has pushed benchmark silver past $50 an ounce, currently trading 51 and 36, just the second time ever. With liquidity evaporating, traders desperate for metal are paying sky-high borrowing costs. India's sudden surge in demand has worsened the squeeze, while London's vaults now hold just a fraction of their former inventory.
On Friday, the market sold off and gold went up. And then today, the markets are rallying and gold's going up. Now, there's speculation that these stable coin companies are now starting to load gold, which is driving gold demand. Again, I don't have any proof of that. That's just the headlines I'm reading. But again, is this more diversification away from dollars, which is very interesting to think that a stablecoin company that basically matches the price of the stablecoin to the dollar is now buying gold.
Silver prices have reached an unprecedented milestone, hitting an all-time high of $52.58 per ounce in London markets as of October 2025. This remarkable achievement surpasses the previous record established during the Hunt brothers' infamous market corner attempt in January 1980. The current rally represents 8 consecutive weeks of consistent gains across the precious metals sector, with gold simultaneously climbing to record highs, indicating robust momentum throughout the entire precious metals complex. Earlier in 2025, concerns about the impact of potential tariffs on silver triggered substantial metal shipments from London to New York, creating inventory dislocations that have proven difficult to resolve. The London silver market is experiencing a severe physical shortage, creating what market analysts describe as a classic short squeeze scenario. This supply constraint has generated extraordinary price premiums in London compared to New York markets, with differentials reaching up to $3 per ounce at peak intensity before stabilizing around $1.55 in mid-October 2025. In this video, veteran commodities trader VinceLanci and Gareth Soloway give a macro-driven outlook on gold, silver, and broader financial markets. VinceLanci explains that London's century-old silver market is in turmoil as a massive short squeeze drives prices. He notes that liquidity has evaporated, and India's rising demand is deepening the supply crunch. Looking at market fundamentals, VinceLanci warns that the system operates like a fractional reserve model where multiple parties may claim the same silver. He notes that relying on trust over regulation has left the market exposed, with physical shortages and heavy leverage now pushing London's silver trade to a potential breaking point. In this private interbank network, major banks like HSBC and JP Morgan settle trades through credit and trust, not physical metal. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from VinceLanci and Gareth Soloway's recent interview.
The first topic is silver squeeze. Planes headed to London to cover shortfall. This is a news item that came out over the weekend that we added some material to. London's century-old silver market is in turmoil. A powerful short squeeze has pushed benchmark silver past $50 an ounce, currently trading 51 and 36, just the second time ever. With liquidity evaporating, traders desperate for metal are paying sky-high borrowing costs. India's sudden surge in demand has worsened the squeeze, while London's vaults now hold just a fraction of their former inventory. As paper and physical markets collide, costly international shipments may be the only relief. That came out over the weekend. What we are trying to do right now is give you the facts very simply so you can make your own conclusion of what is going on and how it is going on and why we are in the silver crisis that we are in. At the center of the global precious metals market sits the London Precious Metals Clearing Limited, or LPMCL. It is the operational hub through which the world's largest bullion banks settle and clear trades amongst themselves. This is an interbank dealing network, something that I'm familiar with, not a customer-facing market. The member banks currently are HSBC, JP Morgan, ICB Standard, and UBS. They transact bilaterally with each other only, using credit lines and unallocated metal accounts to maintain liquidity across the system. These banks face inward towards the hub center when trading with one another, and outward when servicing clients. So you can look at them as sitting in a chair, and they swivel inward to trade with each other and they swivel outward to service largely captive clients. Their mutual dealings form the internal liquidity engine that enables the broader spot market to function. The system operates through netting and book entry transfers rather than physical bar movements, meaning the majority of activity exists as ledger adjustments within a closed consortium. To put a little finer point on it, one of the banks has captive clients. This is my client, and a client wants a market or wishes to buy or sell precious metals. At that moment, let's say I'm one of the banks, I'm UBS, let's say. At that moment, if I do not wish to part with my own metal, or if I do not wish to buy my own metal, what I will do is I will turn into the hub and ask the other members, hey, can someone make me a market? So it's a market maker consortium. The thing is, there's no obligation here. So we'll just stay with the facts. Even though they work together and they trade together, the LPMCL is not a central counterparty clearinghouse. It is not an exchange. It's an over-the-counter relationship. There is no pooled collateral. There is no shared guarantee fund like a regular exchange would have. There is no collateralized risk. There is no statutory regulator. Each member is responsible only for its own obligations to itself and its clients. Oversight comes through the London Bullion Market Association's Good Delivery Standards and annual third-party audits of vault metal, but not through daily reconciliations or external supervision. Between audits, multiple claims can exist against the same metal. Those come once a year, creating the potential for fractional reserve banking exposure within the system. Essentially, within the hub is a derivatives market, and the derivatives market is for neighbors. And all these neighbors will, from time to time, need to borrow sugar from their neighbor to make a cake. And so they'll say, can I borrow a cup of sugar from you? And the metal doesn't have to move, but the guarantee is there. I have the metal. I say I have the metal. I will give you the metal. And then you then take the metal, literally physically take the metal and give it to your client who's buying it. And then you now have a claim on that metal. There could be more than one claim. Does the other bank in your little circle have the metal? Do they have the sugar? Do they even have the credit to give you the sugar? This is a very serious situation. Now, again, LPMCL is not a regulated financial market infrastructure under UK law. It is not a recognized clearinghouse. It is not a central counterparty, and it is not supervised by the Bank of England or Financial Conduct Authority, known as the FCA. It operates as a private, limited company owned by its member banks, governed under English corporate law. Oversight is self-regulatory, coordinated through the London Bullion Market Association. The LBMA sets operational standards, the delivery rules, compliance codes, vault audits, and expects LPMCL members to follow them. It's a self-policing compliance department. The only formal legal obligations come from contract law between the members in the hub and corporate law, company filings, and fiduciary duties. In short, LPMCL is unregulated in the statutory sense. It relies entirely on mutual trust, contractual agreements, and reputational discipline within the LBMA framework. The structure relies on credit and trust, not on legal guarantees.
During the interview, Gareth Soloway analyzes gold's breakout to new all-time highs, noting it still needs technical confirmation before signaling a sustained rally. He explains that gold must close and hold above its key trend line to validate the breakout. Soloway points out that gold's rise, despite both market rallies and sell-offs, shows remarkable strength, possibly fueled by stablecoin companies shifting reserves into gold as confidence in the US dollar wanes. While comparisons to gold's performance in 1979 are tempting, today's market dynamics reveal a more complex picture. Gold is indeed on track for its strongest calendar year performance since 1979, but focusing solely on annual returns oversimplifies the narrative. The current gold market performance exists in a fundamentally different macroeconomic, geopolitical, and investment landscape. Recent developments, including President Trump's statement that he sees no reason to meet with Chinese President Xi and threats of new tariffs, have intensified investor concerns about global stability. Turning to silver, Soloway mentions he recently shorted the metal for a quick gain, but re-entered a small short position, viewing it as overbought in the short term. However, he remains bullish long-term, predicting potentially higher gains over the next few years, depending on how the charts confirm upcoming moves. Let's jump into the interview.
Gold is making new all-time highs today. Now, how do we trade this, right? So you had this hit and pierce of this trend line. We never confirmed, and it sold off. Then you've come back up, and you're making a new all-time high today. The question is it going to confirm today? And the answer is no, it can't. It can't confirm today because once it closes below the trend line again, the technique of confirmation restarts. In other words, it went back inside of its home, the parallel, and it has to pop its head back above that line, stay there, and then confirm again. All right. So these are little nuances to the technical analysis that is, I mean, this is hardcore institutional level analysis, but this is stuff that you got to know. So having said that, we want to see, do we close above this level today, this trend line? If we do, okay, that's good. That's step one. Number two is tomorrow or the next days, do we confirm above it? If we do, then this becomes null and void, and we start looking at our next resistance on gold. But gold, amazing, folks. Near 4,100 on this chart of my the cash contracts here on gold, or the CFDs. And ultimately, just incredible, the resilience. Notice how, and I think this is really important, notice how on Friday the market sold off and gold went up. And then today the markets are rallying and gold's going up. Now, there's speculation that these stable coin companies are now starting to load gold, which is driving gold demand. Again, I don't have any proof of that. That's just the headlines I'm reading. But again, is this more diversification away from dollars, which is very interesting to think that a stable coin company that basically matches the price of the stable coin to the dollar is now buying gold. But again, as people lose faith in the dollar, as de-dollarization occurs, it makes sense that longer term gold probably does go higher. All right, even if it's due for a correction at this point. Silver continuing, it's now pushing above this longer term trend line. I did reshort a little position in silver today. So again, on I think it was it Friday morning or Thursday, whatever it was, I shorted silver. We covered it for about a 5% gain in smart money commodities. Now it's pushing up again, and I did reshort a small starter position this morning just because, again, it has not confirmed above this. Now, just to be crystal clear on my mid to long term. So short term, I think gold's extended. I love my long-term gold holdings are doing great. But, you know, again, I read the charts, right? And so unless we confirm above this level, gold's extended. Same thing with silver. Longer term, I continue to think silver is going to $60 to $62 per ounce in this bull market cycle. So it's not like, oh, in 5 years, in 5 years, it could be at $100 for all I know. I'm just talking about this short-term move on silver. But is silver short-term overbought? Yes. Pull back and then look for that 60 to 62 level on the upside. Maybe it'll go straight there. I guess that's always a possibility, but let's let the charts tell us. If we confirm above this trend line, then at that point, the charts probably are dictating $60 to $62 per ounce. The tolerance by President Trump for a down market is very, very small. And sure enough, he walked things back over the weekend. And that's what we saw here. We saw China backing down, saying that, oh, these export controls on rare earths, not really anything new. There's nothing more dramatic, nothing to worry about. And President Trump also came out and said, hey, listen, there's still a potential for a meeting. We're not going to put these tariffs on just yet. And ultimately, that's what we're seeing this morning. The market's bouncing back. Now, as a technician, I have specific things I'm looking for in terms of trading this bounce. All right. In other words, when you get a massive drop on the charts, essentially off of all-time highs, you get this reversal engulfing candle. It gives you a level to trade against as a technician. In other words, it's a bearish reversal until you take out the high, the all-time high on the market. If we do that, then it goes right back into grind or float up market that we've been seeing for so long. So let's dive into the charts and take a look here. What we're seeing here on the S&P, you can see again, when the S&P futures opened last night at 6 p.m., we were up higher here, and we've basically gone sideways that entire time. Okay, so sideways consolidation as we continue to go here, and we'll keep an eye on that. But ultimately, we're looking at basically gaining back about half of what the markets dropped on Friday. You can see late in the day, in the after hours, the futures had another dump on Friday. But really, when we look at where we closed, the day we closed right here on the S&P, right? So again, we are snapping back about 50% of that drop. Now, what do I mean by talking about that pivot high? So here's the daily S&P chart. And what we could see here is you had this nasty fall on the S&P down 2.71%. Notice how here I write potential breakdown. Okay, now a lot of people would be like, oh, this is a breakdown in the markets. I write potential because you guys know me. Do I go and say, oh, it's a breakout or breakdown the second we close above or below a key level? Or do I say, let's look to see if it's a confirmed breakdown? Because I've been faked out far too many times on these things in my early career, where I had to establish something that really gave me the high probability that it was a real breakdown or a real breakout before I jump on the bandwagon in that direction. And that's what the confirmation signal does that I teach in the Winning Trader series. So yes, we got a break of this trend line, this long-awaited trend line. It came on the 7th hit of the trend line. And that's, again, for those of you that know the methodology, you know that that's essentially a signal there. But in addition, we need to see, does it confirm the breakdown? To confirm, we would have to close below Friday's low without regaining this trend line here on the S&P, which currently sits at around 66.85. If we close above 66.85, the market's been saved, and it goes right back into this wedge pattern right in here. If we stay below on a closing basis, it keeps the door open for it to confirm, but we would still have to close below Friday's low. So really, again, notice how as a technician, and this is something that those of you that are newer are following me, you may be experiencing this, right? Where it's like, oh my goodness, my emotion is kicking in. Big sell-off. Is this the breakdown? Is the bubble bursting? The answer is we don't know yet, but we have specific things that we're going to look for to tell us if that's the case versus just guessing. Guessing does no one any good because we base it off emotion, and emotion ultimately gets in the way of making logical decisions based on probability.
The gold market's impressive performance has been fueled by a confluence of factors, creating perfect conditions for the precious metals' ascent to unprecedented heights. The current squeeze is occurring against a backdrop of broader precious metals strength, with gold simultaneously reaching record levels. This suggests macroeconomic and investor sentiment factors are contributing to the overall environment, rather than isolated manipulation in silver alone. With gold and silver both reaching record highs in the global bullion trade, could this be the beginning of a new era for precious metals, or just the calm before another market correction? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the following video.